Alright, I'm going to try not to make this too long, but I can't promise it. The chances are it's going to be way too long. But anyway, somebody asked me about 401ks, stocks, investing, and I like to answer questions. I could have typed out a bazillion words, but I thought it's easier just to talk. So that's what I'm doing, and of course you can't talk stocks or finances without dressing up, so any excuse to put on a suit and tie, right? Most people don't feel this way. But anyway, let's get started. Now this might be a crazy time to talk about stocks and finances because of everything going on, and you think, is now a good time to buy? Is that what you're thinking? That's what you're thinking. It's now a good time to buy, and I'd say it's better than it was. I mean, it's better. We were at such 11-year bull run, so like so many stocks at their peak. Now it's like everything's on sale, 20% off, 30% off. That said, next week things could be 40% off, 50% off. It's getting worse, but then it's even a better time. Nobody knows the future. One thing I do like about this, I don't know if I'd say like, but one thing that is maybe a positive takeaway is that it's an identifiable problem, so when you remove the problem, then the stocks can return to maybe their highs and go beyond that. But how to, removing that problem, that's a whole different video, of course. Let's just talk about investing in 401ks and all that fun stuff. So to start off, I should have said this at the very beginning, I am not a crook. No, that's not the right line. I am not a professional. I'm not a professional. I have been doing it for a long time, but no, amateur, maybe a little above amateur at best, but I definitely want to clarify that. I don't know if anyone really can be. Nobody knows the future of stocks, a company. It's just impossible. So anyone that does claim to be a professional, you just want to say professional what? Ferris Bueller's Day Off. Yeah, so I just want to clarify that. You don't take my advice. You could lose your shirt. Worse, although if you lose your shirt, I'll probably give you the shirt off my back. I've literally done that once in my life. Someone needed the shirt off my back, and I gave it to her because she needed it for a costume. But anyway, different story. There's going to be a lot of different stories. Nah, there's not. I'm going to stick to this one story. So I think the question was basically, well, how do I invest? And what do I do? Okay, well, first, and I think this was already recommended to him. And again, there's videos, there's stuff like that, but I'm just giving you my 2 cents. Actually, with the recent stock drops, it might be worth 1 cent now. Someone already used that joke today, but I'm going to borrow it and copy it. Yeah, if your company offers anything in the way of 401ks or matching 401ks or exceeding that, then yeah, you got to take that. That's a hard thing to do for some people. For me, I didn't do that for a long time, a very long time. I just did not like the idea of that. I wanted my money now. I want my money now. I want to be able to spend it, and I didn't want to risk it. So those are 2 things that you really have to overcome. Now, if you do put into these funds, IRA, 401k, have to kind of decide. If your company, if it's basically forced to go into a particular fund, then you're done. What are you going to do? But if you have the choice, for me, I had the choice of the money could go in and sit there in like a money market fund and not be invested really into a particular stock or any funds. So the money's on the sideline. So actually the money is really no better off there than a good savings account. So that's one thing to consider. You actually have to sometimes actively put it into funds depending on the program. So just keep that in mind. Where is the money? Is it actually in, you'll kind of know because it'll say like Vanguard or these fancy names for it. But otherwise, if it's on the money market, then it's just sitting there. So in 10 years, it could be worth close to the same amount, so it'll have done nothing. So what was the point of it all, aside from tax avoidance? So you basically can put this money in and not be taxed on it until maybe a later date, or maybe never. Again, maybe I'm saying something totally wrong. Maybe you're looking at it thinking, you are so far off, James, that it's not even close to being correct. Write a comment, leave a comment. I don't know. I'm in a minute right now. I don't know everything. I can't say that. Now, leave a comment. If I'm wrong, I'm wrong. Okay, so now if you got your 401k or your IRA, or you don't even have to have those plans. You could just sign up for Charles Schwab or E-Trade or Ameritrade or Morgan Stanley or any of those things, and you could just invest this the same way. It's just if you do it, you can get taxed. There's some tax things to consider. So you do it through those programs. Or if you're not an employee somewhere, you can do it individually. Just you have to find it. It is good to speak to someone about that. They can provide some advice, maybe even at the place. Talk to Charles Schwab and say you want to try and get it in there pre-taxed, and then not have to worry about that. Then remember, the thing about this is you can't really get it back out until like retirement or maybe many years in the future. So you don't really have access to that money without being penalized. I mean, if you had to take it out, you then would have to pay the taxes on it. So this is money you really, I mean, the whole purpose is like for retirement. You're supposed to retire. I don't know, it kind of changes, but they say it's good to have like 2 million, I guess, by that time, to be really safe. And that seems like a lot of money. Even 1 million seems like a lot of money, especially if you start late, which really makes it a lot harder if you miss out and you're not really starting. But the American way has really changed. It's not like you go into your career often at like 22 right out of college and stay there for the next 40 years. A lot of things happen, a lot of changes. So, and what's possible depends on a lot of other factors. And maybe you do have some need for the money right away, but whole different video. But still, what funds do you put the money into? So what do you do? I mean, what are these things they talk about? Well, you hear index funds a lot. Index fund, that's a type of mutual fund. And again, look it up too. I mean, do research online, watch a video, or other videos are great to watch and get more information. But a type of mutual fund. Okay, what's a mutual fund? All right, a mutual fund, I'd say it's a kind of a, well, mutual, kind of all together, benefits everyone. That's mutually beneficial. But so everyone pools their money together, and sort of stocks are bought that way. So many stocks are bought through a collection of money, so a pool of money. You don't control that. That can be controlled by someone else, or EFTs, exchange traded funds, and those are sort of like auto-controlled. The market has sort of like a machine almost controlling everything. Again, if my definition's wrong, leave a comment. That's all right. This is as to my understanding, and I don't research that often actually. I'm missing a button. I'm not gonna go back and restart my video. Is it one button? Okay. The things you miss when you don't have a mirror. Okay, so you got your EFT or your index, and they're kind of, I think there's a lot of similarities. Supposedly your returns are a little higher on your EFTs, exchange traded funds, but there's not really a lot you have to know. EFTs, mutual index funds, they're just collections that buy stocks. But you can pick often, if you do have a choice on the matter, you can pick like what type of fund. Well, what types are there? Small, medium, large, domestic, foreign. I've even done some foreign funds for fun, and just to see, because I kind of felt, well, maybe they're going to do better in Europe this year or in the future. I don't know. It doesn't always work out that well. And you can also decide like low risk, medium risk, high risk, and of course, the low risk but low return, high risk, high return. So you kind of figure, I kind of like to stick to the middle if I can. But then again, I mean, sometimes you got to go big or go home. And the other thing is that the sector. Sometimes you have a choice of the sector. So if you want to do like tech or commodities, so you can kind of, the name sometimes will kind of identify what the collection of stocks is going to be. If it's tech, okay, maybe you got your Apple and your IBM and your Intel. You don't have really any choice of what stocks are in that fund, but if you get the fund, you can kind of see, you can usually see like, okay, this fund contains these, but the S&P 500. So there are a lot of funds where you can kind of see like what's made up of those funds. Even the Dow is calculated on a bunch of different stocks that are in the Dow. So you can kind of look through it and just see, okay, do those tech companies look good to me? Or you just really got to trust the fund itself. And you're not going to have any control of saying, let's get rid of this stock and replace it with that stock. That might happen, but you kind of want someone else to do all that work for you, because who has time to sit there on the internet all day and research these companies? You really have to be, that's where you really have to be an expert. And who of us is? So for me, I'd say a lot of my money is really in those EFTs and index funds, and I mean, just buy gobs of it. And I don't know if you talked about it, but dividend reinvestment. So basically, they have a small payoff quarterly maybe, and that money goes into buying more of that stock. So at time you get more, it buys more, but the more you have, the more you can buy. So it just keeps growing and growing. That compounded interest, and that's sort of what Oracle of Omaha, basically everyone tells you that. It's like that's the big thing, is interest over time. Let it keep growing your stocks, and it gets bigger and bigger. Because this is something you really can't do almost any other way to the same level. I mean, with exceptions, but real estate sort of almost can have a finite of how fast it grows, but this thing is just kind of awesome. I mean, this is why people do it. It just can grow and grow and grow. No, sometimes it can just implode. We have things that happen. People even go to jail for stuff like that. So there are risks. There's always risks. I think of dividends, stocks and dividends kind of like a house. So you got a house, and it appreciates over time. So that's kind of like the stock, and the stock grows. There might be a fund like Amazon, where it just starts out really small and just keeps appreciating, getting more and more valuable. And if you got 10 shares that you bought at 300 and it goes to 1,000, what do you got? 3,000? 3,000 to 30,000. Well, you get the idea. You got to do some math there, but it just grows. But a lot of stocks don't pay a dividend, so you'll never get any more stock automatically. You'll always have 10 shares unless you actually buy more shares. Other stocks will have that dividend. You just say, use that money to buy me more stocks. Or that money can go on the sidelines if you don't reinvest it. So then that'll go into your money market fund. And then I had a whole collection of stocks where I just ignored for years, and then I didn't realize it wasn't investing the dividends. The next thing you know, there's like $10,000 sitting there on the sidelines, but I'm thinking that's been there a long time, and that money's really done me no good. The nice thing is that it's all set ready to buy. So when we had this like whole thing go on, this big bear market, this big turn, the end of the bull, the money's there, so we can start buying stuff on sale. So if a sale does come along, like we have, then great, we can start buying all the stuff with it. But it probably would have been a lot more useful to have that money keep buying more stocks. So it did miss out on that. Oh, and the other part was, yes, okay, so the appreciation is like the stock growing, and the dividends, it's like renters paying you money, along. So you got the house is appreciating and the rent is the dividend, so you just keep getting more and more money, and maybe the dividends go into buying more of the house, which appreciates more. I guess that's one way to think of it. And I think that's basically it for the EFT index, mutual fund, 401k, IRA, all that kind of stuff. Those are the big words people use. Yeah, if you just go into Charles Schwab and say, I'd like to start an IRA, I'd like to start a 401k. But again, go with the company to check with your company first. If your company's often matching 401ks, then just grab it. Depending on age, maybe maximize it just to make sure you're kind of really starting to prepare for the future. Again, money, it's nice to have money now. One of the big things is like, obviously, you want to do this, but you got to have food money first. I mean, if you can't, food and rent have to come first. So if there literally is no disposable income for something like that, then well, I mean, what can you do if you're already month to month? So I would just say, just try and get anything in there, even if it's small. There actually is, there's like Acorn, or I don't know if it's Robinhood, but there are accounts specifically for your pocket change. So instead of like the, I don't know, Starbucks coffee every week or morning, you put that money put the money to work. You got to have some. I mean, you can do it in real estate, but actually you should try and do both, real estate and the stocks. And there are other ways too, but those are the two main ones. You just gotta start. Don't start late like me, because I lost a lot of money, I guess, over time. Yeah, I started way too late. I think I covered the basics, but now you're probably saying, well, wait, I just want to buy Apple, I want to buy Amazon, I want to get in on that. And you can, I mean, the same thing, you go to Charles Schwab, you open an account, an E-Trade account, you can do that online. You used to need $1,000 to start it, or maybe 500, it might even be nothing now, it's just $10, but yeah, you can open an account and put money in it, and you're free to do whatever you want. So you can actively buy individual stocks. Hey, they'll take your money. And then you have 100% control. You decide when to buy it, when to sell it, what to do with the dividends. You decide everything. But you also assume all the risks, which is fine. The company is probably going to be around forever. I mean, Facebook is probably going to be around a very long time, unless someone comes along with a better social media, what do they call it? Social media? Yeah, better social media platform. What's the other one? Google, better search engine. So those companies could go, they could be a fad, they could go away, but they've been around a long time. The same thing with the big companies, GM. Then again, I don't know. I mean, sometimes these companies get into trouble or don't survive the big turns, like the 1999 turn, the 2007 turn, and now I guess the 2020 turn. So a company, one thing to keep in mind is a company does have to be able to survive. There was a line on Last of the Mohicans, great movie, but he said, just stay alive, I will find you. So a company throughout these big recessions has to stay alive. If they fold, then that's it, game over, man, you get nothing. So bankruptcy is not fun. And I've gone that way. I've done big in oil, and these oil companies, when oil dropped from $150 a barrel to, I don't know, 25, the companies didn't last. They just didn't have enough money, and they finally went under. So lots of lost money there. Doesn't always pay off. So if you speculate, that can happen. So you got to buy stocks at your own risk. It is fun because you get your own control, and I don't like to call this gambling, but there is risk involved. And again, if it's an index fund, and they kind of see this company's headed for trouble, they can kind of boot the company and get another fund in its place. But if it's you, are you really going to be privy or up to date on the information to where you can stop it in time? Or get out before it's too late? And for me, it's like sometimes I don't get out before it's too late and the company goes bankrupt. But other times I got into Tesla at a very good time, at $20 a share or something, and it's done pretty well. Lately, it's gone on sale too, so if someone wanted to get in, maybe it's time to get some Tesla. As far as when to buy, I think whenever you're ready to start investing. Timing the market is kind of a fool's errand, and they all pretty much advise you just can't be done. Don't try it. Buy low, sell high, I think is one of the key strategies, which makes total sense. But it's hard. Well, I'd say it's easy to get kind of trapped in the other direction. The market stocks start going up, and you think, oh, this stock's going really high. It's the highest it's ever been. I want to get in on that. FOMO, and then you buy it. So you really kind of bought it at its peak, and then the stock starts tanking, and you think, oh no, it starts going down, so it's going really low. So then you sell it. So you've just done the complete opposite of what they told you to do. But it's easy in theory not to do that, but sometimes in practicality, the stock starts sinking, and you think, I need to get out. It might, in hindsight, be a good choice. If I got out on the oil, I could have saved something, but I stayed in and just figured. Overall, on the average, it's better just to, overall, it's better just to set it and forget it. Buy. The ideal hold time is forever. Just don't time it. When you're ready to buy, just don't worry about, day of the week or anything like that. Just buy and wait forever. Set it and totally forget it. I mean, I check my stuff, especially when the market's doing well. I check it a lot, but don't do anything with it. It's just fun to see. It's like a game, I guess. That's the best way to look at it. Because again, overall, time is your friend. Now, when you're at the casinos, time is your enemy. The longer you play, the more likely you are going to lose everything. Well, I think it's the opposite in the stock market. If you look at a 100-year graph of the Dow, it just kind of diagonally keeps going up. Now, it has these bumps where things go down and then they go back up. But a lot of stocks recover and surpass even what they were before. Not always. I had something from Cisco from like 1999, and it tanked on that great .com implosion, and it's actually never gotten back. Even during this 2007 run, it never made it back. It's still alive. Cisco's still around, but it's just one of those key exceptions where that stock has actually never gone back to where it was in 1999, whereas other stocks have just gone way off the charts a bit. But overall, like I said, time is your friend. The more time you have, because we had a 11-year bull run, but doesn't mean we can't have a pretty long bear run. I don't think it's going to happen personally. I think once the virus leaves, I think we're going to be okay and the stocks are going to return. But how much damage or how many companies will go out of business because of it? Probably not Apple or Microsoft or any of the big ones. And hopefully your index funds would be protected, at least mine would be protected. But it's all good to know. It's all good to keep in mind. Buy low, sell high, or even better, buy and hold forever. I think that's the takeaway. Buy and hold forever. Just don't get too scared. And if the worst case happens and the stocks market entirely collapses and never recovers, then we've probably got more things to worry about. Then money probably isn't going to matter at that point. You're going to probably want to have food and some way to protect your property. Hope that helps.